Hi everybody, this is John. Welcome to the free video. And this market continues to be very volatile. I would like to look at a couple of things here. One I like here to the long side, even if on a shorter term basis, is Facebook. Why is that? First of all, it's one of the few weekly charts that's maintaining its bullish posture. You've got the 8 on top of the 21, on top of the 34, on top of the 55, and on top of the 89 period moving average, and prices above the 21. And that by definition is a strong uptrend, even with all this craziness going on. I also like here that there's the beginning of a new squeeze here, okay? And we've got momentum coming higher, and today the NASDAQ futures retested the lows while Facebook held strong, which is a bullish divergence, okay? And it looks like tomorrow we could get this. So I'm looking for Facebook here simply to move to the top of this current channel, which would take it to about $105, okay? So how do you structure this trade? Well, I like to do a combination on something like this. When we're getting into a signal like that early, is I like to start off with a directional position that's a little bigger than normal, okay? But then offset that with the put credit spread that helps offset the premium decay. Because if you just buy an option, essentially every day you're losing a little bit of premium. Now hopefully the stock rises enough to offset that premium, but if it doesn't, you're just losing money every day. To offset that, you can sell a put credit spread, and then the premium you make here can then offset or partially offset the premium you're losing here. In a perfect world, what happens is you buy this, in this case with Facebook, we rally up to 105, okay? And in this case, then we take profits here. That's the directional trade, and the faster that can happen, the better. Because remember, even if it goes to 105, if then we hold on to those calls and it trades sideways for 4 or 5 days, we're going to be losing money on premium decay. So the key with this is you find what I call the slam dunk layup level, and if you get up there especially quickly, just get out, okay? Then we can continue holding the put credit spread. All right, so that's how we're playing that one. Another example of this, it's very similar to what Facebook is Gilead. So on this particular stock, what we did is we actually got into a trade back in here where we bought calls with the idea that we could just come up and fill the gap. That's all we're looking for, and then sold puts. All right. And if we come back and we look at how that's working now, so when we did fill the gap, we sold the calls and made a couple of points on those, and then we're continuing to hold this put credit spread. So we sold this for $1.57, and right now we could buy it back for 29 cents. All right, that means we keep the difference. It's kind of like if you ever bought an option for $1.57 and suddenly it was worth 29 cents, you'd be down money, right? And if you bought 50 contracts, you'd be down $6,375. But what's nice is that if you actually sell it, and in this case we do it as a spread so as to limit our risk, then that money flows into your pocket. So now what we've got to decide is tomorrow, Friday, if Gilead closes above $86, then we actually get to keep this money too, which would be an extra $1,500. Okay, that'd be fantastic. However, at this point, of course, we don't want to take a ton of risk and have Gilead fall well below $86, and then all of a sudden we start, losing money on the trade. So obviously, we're going to keep a close eye on that. But the same strategy that we did with Facebook, or we did with Gilead, we're doing with Facebook. Those calls we had, we only held them for like 2 days, and then we bailed. And then last but not least is LinkedIn. Now LinkedIn is a stock that got hammered on earnings and now is just kind of trading sideways, and it was up a little bit today, but this is one that I don't think is going to be able to rally very far. So on this one, instead of selling a put credit spread, and if you sell a put credit spread, that just means you're expecting the stock to essentially not go down more, though you ideally it rallies to give you some cushion. In this case, we sold the 104 110 call credit spread for $2.23. We had some good profits on it yesterday, but today it rallied a little bit, so now we're back to about a scratch trade with an open P&L of $180. But the bet here is that by the end of the next week, LinkedIn is below $104. Of course, this is our stop loss if it just blows through it. Now, if the market gets really crazy to the upside, I'll probably cut this one loose, but I like to have some call credit spreads in this market too, simply because this market has been volatile. Obviously, it's been in a downtrend, and we want to have some exposure to that if that downtrend should continue. So if all of that sounded interesting to you, or if it sounded like Greek, like I don't know what you're talking about, Henry and I are going to be doing a class exactly on that this Saturday. and this is a beginner's options class. We haven't done a beginner's options class, gosh, in I think 2 years. And if you are a brand new trader, you don't know anything about options, then this is the class for you. Now, if you're, let's call it an intermediate trader, the question would be, are you going to get anything out of this? I'll be honest, the Saturday class is going to be pretty basic. Options 101, how to profit from maximum leverage with minimum risk. And I'm going to be talking about layering into trades and things like that too. Which stocks and ETFs to trade. So it'll be pretty basic, but a lot of times I found that it's a good kind of a reminder. Okay, and it's like get you back into the groove, get your groove on, and especially if you've been having a rough time or anything like that, this is a great way to like, all right, take a deep breath and let's knock this out. The part that will benefit is the live trading parts. We're actually going to be doing 2 days, February 16th and 17th during market hours. And this class, it's just $497, and it includes the Saturday class. I know a couple people, they're doing this, and they're just going to skip this class. They don't think that they need it, but they know that the live trading by itself, I can't guarantee this, but typically, if you're trading one contract over 2 days as intensely, because I'm not just trading an hour. Henry and I are there all day. You're typically going to make your money back and then some. Okay. And it's just great just being able to actually spend time, from soup to nuts, as opposed to popping in for an hour like in the trading room and stuff like that too. So that's what we'll look at, and hopefully that makes sense. You guys have and by the way, if you can't make it to the Saturday class but you want to go, we're going to be recording it. All right. You guys have a great rest of the night. We'll see what's in store for tomorrow, and hopefully see you on Saturday.